All right. No. Well, first of all, thank you, Volker, for the invitation. Good morning. Well, good afternoon to all of you. So what I will do is I will present an overview over the changes to the Eurosystem's operational framework that the Governing Council decided on 13th of March. The decision indeed marks the outcome of the operational framework review that took place over the last 15 months. And of course, the decisions that were taken are aimed to ensure that the framework, the ECB's operational framework, remains fit for the future. That means it remains effective to implement the monetary policy stance, to steer short-term interest rates in line with the Governing Council's monetary policy decisions. So let me maybe...
Yeah, now it works.
Let me maybe by way of introduction just give you an overview over the different implementation regimes since the existence of the ECB, and you see here on this slide that before the financial crisis, the ECB operated in a corridor system. That meant that the ECB provided liquidity to the banking system just enough to fulfill the aggregate liquidity needs of the banking system, and by doing that, it was able to steer the overnight interest rate just close to the main refinancing rate, so the main lending rate of the ECB at the time. Then since the financial crisis of in October 2008, the ECB switched to a fixed rate full allotment procedure in their main refinancing operations, so banks could demand as much liquidity as they wanted against adequate collateral, and that led right away to banks taking on sizable amounts of extra reserves, and that led to the overnight rate dropping to the bottom of the corridor, being then more steered by the deposit facility rate and not the main refinancing rate. I mean, obviously, you see that in 2011, you see it also in 2014. There were episodes where excess liquidity actually came down again, and interest rates moved more towards the middle of the corridor again. But these, let's say, shorter episodes were usually interrupted by yet another series of non-standard measures. So in 2011, we had the 3-year longer-term refinancing operations. In 2014 was the beginning of the targeted longer-term refinancing operations. Later on in the year, the covered bond purchase program, ABS purchase program, and then, of course, as of 2015, you see the big increase in excess liquidity injected through the asset purchase programs. And since then, you can see that the overnight interest rate is actually well anchored at the bottom of the corridor through the deposit facility rate. But just to also mention that besides, let's say, these supply-driven effects and injections of reserves, of course, one should also not forget that during or since the global financial crisis, also the demand side for reserves probably has changed. So banks induced, of course, through the many, let's say, crises through which the euro area went, probably have a more of a preference for holding extra amounts of reserves in terms of precautionary holdings to meet potentially deposit outflows, to meet potential margin calls, but also to potentially meet regulatory requirements. So that, of course, is a little bit overshadowed by all the injections of liquidity through through these non-standard measures, but also to not forget that there's also a demand side in this picture. On the next slide, you see that the balance sheet is set to decline over time. So on the left-hand side, you see that the balance sheet already declined by roughly 2 trillion euro, mainly driven by the repayments in the targeted longer-term refinancing operations, but also the decline in the asset portfolio. On the right-hand side, you see the liability side, and you see that excess liquidity has fallen by 1.2 trillion from the peak of 4.7 trillion in mid-2022. And the projection is that you see in this chart is that excess liquidity is expected to fall by another 1.4 trillion to roughly 2.1 trillion by the end of 2024. And this chart is just there to illustrate that we are facing quite some uncertainty over key dimensions, notably over the reserve demand, and at which point the level of reserves in the system has fallen to that extent that it exerts upward pressure on money market rates. And what you see in this chart is that history may not be, let's say, a good guide, in the sense that the observations where you actually see excess liquidity falling to the degree that money market rates are rising are all from, let's say, prior to 2015. So we are, let's say, since 10 years in a phase where excess liquidity is so high that money market rates are really centered around deposit facility rate. And as I mentioned, during that period, of course, supply has overshadowed possible changes in the demand side. And therefore, there's quite some uncertainty over what is now the new, let's say, desired level of reserves that banks may wish to hold. And so the announcement on 13th of March of the new framework can be seen as, let's say, providing at least a framework and a certain set of parameters that will help market participants to adjust to a situation of lower reserves, to an environment of lower liquidity in the system, and also will, of course, help banks then to prepare for this environment going forward. So let me now maybe outline briefly the main design features of the operational framework. And so the key element is that the DFR, so the deposit facility rate, is there to steer the monetary policy stance. So short-term money market interest rates are expected to evolve in the vicinity of the deposit facility rate. But of course, there is some tolerance for volatility. So if there is short-lived volatility that does not blur the signal of the monetary policy stance, that will be tolerated. But of course, the expectation is that money market rates are still centered around the deposit facility rate. The spread between the main refinancing operation rate and the deposit facility rate will be adjusted as of 18 September to 15 basis points, while the spread between the marginal lending facility and the MRO will remain at 25 basis points. And especially the spread between the MRO and the deposit facility rate is chosen to incentivize still sufficient bidding in the main refinancing operations, so that indeed the money market rates are evolving in the vicinity of the deposit facility rate. And that's also reinforced by this higher spread between the MLF and the MRO. So, that keeping that spread or making this spread 25 basis points and not 15 basis points provides, let's say, an extra, or makes it more costly for banks if you want to run into liquidity shortages, and therefore incentivizes to some degree precautionary demand, and therefore supports that short-term money market rates will evolve in the vicinity of the DFR. At the same time, the spread is chosen, if you want, big enough to leave also some room for money market activity and to provide incentives for market-based funding. So the spread introduces the costs of holding extra liquidity, and so it puts a price tag on the liquidity provided by the central bank, and therefore reduces incentives also for banks to fully rely on the central bank, but also to look for market funding in the money market. The next important change that was announced was that the Eurosystem will provide liquidity through a broad mix of instruments. So short-term credit operations, the MROs, the 3-month longer-term refinancing operations, LTROs, and then at a later stage, structural longer-term credit operations and a structural portfolio of securities. Now, the key tool to steer liquidity will be the main refinancing operations that are offered still at fixed rate full allotment against broad collateral. So that introduces a demand-driven component to the framework, where banks can always fulfill the liquidity needs with accessing the MROs. So liquidity is always there on demand of banks, and providing it through fixed rate full allotment procedures in, let's say, a fully elastic way, of course ensures that let's say banks are somehow insured against sudden liquidity imbalances, which also supports financial stability. And let's say that the main refinancing operations will be the main tool and will be also provided in that through the fixed rate full allotment procedures. Of course, also reflects the very bank-based nature of the euro area banking system, and also reflects that, of course, all banks in the euro area in every jurisdiction should have access to our operations and has easy access to these operations. Now, the new structural longer-term refinancing operations and the structural portfolio will be introduced at a later stage once the Eurosystem's balance sheet begins to durably grow again. So that means that we do not want to rely only on the main refinancing operations to cover all liquidity needs, because when you also look back at the slide that I showed on the projection of our liabilities, of course these liabilities are quite sizable in the future. So if you think of banknote holdings are currently at 1.66 trillion. So to fully provide that much of liquidity through the main refinancing operations would also imply some operational risks. So these more structural liquidity needs will be then provided or will be provided to a large degree through these structural operations, both refinancing operations and the structural portfolio, to provide, let's say, a stable source of liquidity for these more structural needs. And maybe maybe just to close with an illustration how this balance sheet would potentially evolve going forward. So you'll see here, again, just a stylized representation where our balance sheet is set to decline through the decline in the legacy portfolios. At some point, however, liquidity needs through the autonomous factors, through minimum reserve requirements, but also through, if you want, the extra reserve needs that banks will want to hold. This requires the monetary policy assets to grow again, and so liquidity would again need to be injected into the system. This will slowly happen over time. So the prime tool, of course, will be the main refinancing operations, and you see this that in the yellow area that the main refinance or the credit operations in general will start growing again, and it will also potentially already grow over time because, of course, not all banks have the same amount of extra reserve in the system, but reserves are unequally distributed in the euro area. So some banks may already come to our credit operations earlier than others. And once, so the MROs will start growing, but as the legacy portfolio continues to decline, and of course, let's say the more structural liquidity needs coming from the autonomous factors, banknotes, minimum reserve requirements, will require an injection of liquidity, then these structural operations will kick in over time and will play a role in filling the liquidity needs of the banking system that are rising more from these structural needs. So let me just close by saying that a number, of course, uncertainties remain. That's why, well, first of all, the Governing Council did not fix the exact specification of these structural lending operations and also the structural portfolio. So that's left for the future to design and to specify. The Governing Council also, of course, acknowledges that these uncertainties exist, and therefore that there might be a need also to, let's say, observe how market actors adjust to the new environment, and that's reflected in a review clause that was built into this new framework, where the Governing Council announced that in 2026 they will review the framework again based on the experience that was gained, and to indeed have the flexibility to potentially adjust then parameters if that's judged to be needed. And I think with this I can stop.
Thank you, Tobias. So now we switch to Jens. If you can share with us a bit what you think are the pros and cons or strengths and weaknesses of what the ECB ultimately decided to do.
Yeah, thank you very much for having me. It's great to be next to Tobias to talk about the ECB framework review. I put this, yeah, okay, great. Let's maybe start with the things we know, and then I'll come later to the points that could be questions or could be things that are interesting to watch. Let me also first say that I think the way the ECB has done that makes perfect sense. Basically, it has given relatively scant details in a situation in which these details anyway wouldn't have mattered. At the same time, it has provided a roadmap in terms of how the balance sheet normalization, if you think of normalization as a process of a rundown of the legacy portfolios, as they were called here, is described. So basically, there is a roadmap how this can look like. There is some certainty in terms of where marginal funding can go, funding needs can go, and then one reserves judgment in terms of what else is to be done and how exactly these else to be done things will be designed. So first of all, what do we know? EUR-STR, or in the market, nobody understands EUR-STR. Everybody thinks it's Esther. We all know it's not Esther, but that was the first design, Esther, and then there was a trademark conflict, I think, and that's why it's now EUR-STR. Just saying, if you tell any trader on the market EUR-STR, they will look at you and think you don't understand that short-term rates are called Esther. So I put here a question mark. EUR-STR will be still close to DFR. That's what the ECB has said. I put the question mark here because it's not clear that this will be EUR-STR. Why? EUR-STR is a very much asset purchase program driven rate where non-banks, so entities without access to any of the facilities of the central bank, trade with banks, which is also the reason why it's below the DFR rate. And of course, how do non-banks get to all that liquidity? Well, through asset purchases. And now, of course, if asset purchases in the long run will be much smaller, at least that seems to be one of the declared aims of the framework review, then at least you have to put a question mark behind whether that rate will continue to be the predominant rate. Why could it not be a predominant rate? Where, for instance, if interbank transactions are to come back and coming back in secured markets, which they are now predominantly, then you would have to look also at the repo rate. So my expectation would actually be that the ECB will be attentively looking into also that sort of segment of the money markets. And of course, there is, I think, repo SDR, and I mean, maybe by implications, there could be other rates. So, but it said it will be still close to DFR, and some volatility will be tolerated. It's not specified how much volatility, but already the spread of 15 basis points gives an indication, not an awful lot. So the idea is to have relatively limited volatility in here. Then the MRO is meant to play a key role in the provision of margin and liquidity. And again, liquidity is provided at fixed turnover full allotment, which is departure from the pre-crisis system, sort of permanent departure. There were times at which the ECB would always prolong the fixed turnover full allotment regime for another half a year, so that morphed from a non-standard measure into a now standard measure. I think that's important to underscore. And of course, it's from the 18th of September, so from that 6th maintenance period. And then 2026, or earlier, if need be, there will be a review of the parameters. And we have just heard also from Tobias, there will be further ingredients, namely a structural portfolio and long-term refinancing operations, even though these are kept a little bit more vague now. What do we actually learn by 2026 or earlier, if need be? I think we took this with a lot of sort of pleasure to this observation, because if you look into a forecast of excess liquidity, which you have here on the right-hand side, so our in-house forecast based on an ISIN level portfolio, which we simulated what we think the ECB has. It's of course not what the ECB has, but it's relatively close from what the ECB has, given what you can observe in the market and the maturities that were always then are published. Then you see that you reach by the end of 2025 around, as Tobias would say, 2.1 trillion. We would say nobody knows the level of reserves at which short-term rates start to increase and the MRO starts to be filled. But I would say, from 2 trillion onwards, I would start paying really attention, and I would imagine that the ECB is of the same opinion. And there's a reason why 2026 figures here, because you reach essentially levels of excess liquidity that are deemed critical. So I think that's what we can, in Sherlock Holmes mode, observe from. The fact 2026 is not by coincidence. It's essentially the time range when excess liquidity starts to get interestingly low. And that's then, again, for the review of parameters. There's this or earlier, if need be, which means the ECB is not sure whether it can actually already happen before. So essentially, it could be even above 2 trillion. Then, what are the open questions? When I sort of read this and look at this from a perspective of framework design, first of all, there seems to be a hope that liquidity is provided through an asset purchase portfolio, whatever that structural portfolio will look like, plus some sort of long-term refinancing operations, and then only the marginal liquidity will be provided in the MRO, but that will be provided at potentially 15 basis points above where you hope short-term rates will be. But if that sort of hope that short-term rates will actually be at the DFR will, to a large extent, depend on how large the MROs are. So basically, the split between refinancing operations and portfolio is not innocent, also not neutral to the level of rates that you observe. So in extreme cases, everything is provided in the MO, which I take it the ECB doesn't aim at. You don't get an alignment of EUR/STR with the DFR, you're rather at the MO. So basically, implicit already in that design is that only a small fraction of reserves is provided in the MO. One could think of MO caters entirely for fragmented liquidity demand. Think about peripheral banks that may have a higher price they are facing in the bank market. They could all be in the MO. The core banks could all be delivered with liquidity in privately organized markets. And to the extent that the 15 basis points hope is essentially met by reality, then you can have indeed that rate configuration that's essentially hoped for. But what I guess I want to say is here that the ECB will be attentively watching both the population of the MO as well as the size of the MO, and it will be a critical parameter in framework design. Then the other question that's open is how strong will be the push for a small portfolio? And what I mean by that, if you think about the liability side, that essentially is we're talking about. So basically the question is, and you hear it also from the framework press release, there's essentially a question, what is driving the demand for reserves, which is the liability side of the central bank. So there's longer term structural liquidity needs, think banknotes, and I guess the easiest one would be to think of this as being catered for by the structural portfolio. Then you do have regulatory induced demand. Again, there could be some structural portfolio plus also the new longer term refinancing operations, which are beyond 3 months in size and in maturity. And then, of course, there's also the marginal liquidity need that essentially means to balance out high frequency autonomous vector shocks, and this should be the MO. If that's sort of your conceptual thinking, then the question is, I need to have a very attractive longer-term operation, or the more attractive I make them, the smaller will be my portfolio and vice versa. Because, I mean, if you sort of come up with long-term operations that are not conducted at an attractive enough rate, or otherwise, because of the collateral set that is applicable there, not as attractive, then your portfolio will have to be relatively large. On our own estimates internally, we think, and it goes also back to the question how large the MOs can get in order to have steering of rates close to the DFR, we think the portfolio will probably have to be between 2 and 3 trillion in size. And in case you want to go below, then you have to actually make a splash in terms of making the LTROs, the longer term operations that are beyond 3 months, very attractive. Final question from my side, and here will end my my comments. What's the role of MRs? The framework review was, I think, very convincing in terms of outlining essentially the principles, which are, I observe, are very old principles and have actually a root in, or a source in EU primary law, which is great. It's also a fantastic roadmap in terms of thinking about how the ECB will be observing an MRO that increases in size, plus maybe some EUR/STR that creeps up. But what is not clear to me, what are MRRs here? I mean, you have FRFA, you have fixed rate and full allotment, completely inelastic liquidity provision. Plus you have an MRR that is an obligation for a bank that's remunerated at a rate that's lower than the rate at which you eject reserves. So it's a permanent tax on banks. So it's essentially a stance tool that doesn't really belong, in my opinion, in that framework, which is otherwise a very clearly structured affair. So I think that's all from my side. Thank you.
Well, thank you. Maybe let's wait. Do you want to respond to Jens before we turn off the video, or just say something to the companies?
Yeah, no, thanks a lot for this discussion. Maybe on the question of the excess liquidity and when will we see potentially also upward pressure on rates. And if we could go back to actually my presentation, if you look at this chart, it's actually quite interesting when you look at the 2014 period, right? Because what you see in 2014 is that indeed you see in the gray area that excess liquidity goes down. and rates are slowly moving up to the MRO rate again. But what you also see in that period is that excess liquidity is not going down to zero. That means at some point, indeed, banks have a willingness to pay for holding extra liquidity, and that willingness to pay is indeed the spread between the MRO and the deposit facility rate, right? And of course, that happened in 2014, and again, I mean, there's a big uncertainty, of course, over what is this extra level of reserves that banks want to hold. And let's say the way that spread was now calibrated was that the 15 basis points are meant to, let's say, have the spread small enough to still incentivize take up in the MROs, and take up in the MROs to an extent that banks are indeed taking out a little bit more liquidity that they maybe need, and therefore money market rates will still be centered around the deposit facility rate. But at the same time, the spread, of course, should also be big enough in a way to still have some incentives for trading within that, let's say, 15 basis point spread range in the money market. So that's maybe one thing, and also there the look back into history is actually quite interesting. Indeed, that's the question on the MRO anchoring. Why 15 basis points were in the end chosen? Again, I think it's. I mean, we have these operations are at fixed rate full allotment, and they're against broad collateral. So obviously, they are attractive from the perspective that banks can, of course, also potentially bring non-HQLA collateral, receive central bank reserves that are eligible also for regulatory requirement purposes. And therefore, again, there is this built-in incentive to take out liquidity to a sufficient degree that helps the steering of money market rates. But again, the spread is also there because, of course, within that spread range, it will also make sense for banks to trade liquidity in the money market. On the longer term operations, the size of the structural portfolio, the attractiveness of operations, obviously I cannot say much. I think the only thing indeed that the governing council saw with these operations are that they should indeed be there to provide some sort of stable source of liquidity to cover for these structural liquidity needs. And by the way, also there, it's also not something entirely new, no, because when you also go to the Eurosystem balance sheet before the financial crisis, also there, let's say there were portfolios held at the national central banks, so portfolios that were held for investment purposes and so on, that were of course also covering, so to speak, the part of the liquidity needs of the banking system at that time. So to have a split of, if you want, tools that are providing liquidity to the market is also not entirely new. The new thing is that it will indeed be, let's say, a more centralized portfolio that would be operated by the Eurosystem and the ECB. And again, these longer-term refinancing operations, also those are not entirely new. We had the 3-month longer-term operations also throughout the history of the ECB. Again, what type of new operations, what's the pricing mode, what's the maturity, that's all up for future decisions.